recognize that our work and the work of our students and members takes place on traditional treaty and unceded territories across Ontario. CPA Ontario's head office is located on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. CPA Ontario also acknowledges that Toronto is covered by Treaty 13, signed with the Mississaugas of the Credit, and the Williams Treaties, signed with multiple Mississaugas and Chippewa bands. We acknowledge that this land is still home to many diverse First Nations, Inuit, and Métis peoples.
Welcome to CPA Ontario's inaugural Standards in Focus Fireside Chat. My name is Janet Gillies, and I'm the Executive Vice President of Regulatory and Standards here at CPA Ontario. It's become a cliche to say that the world is changing and changing quickly. And as the global economy evolves, global standards are evolving with it. So that's why CPA Ontario launched Standards in Focus, our new guidance, research, and alerts to help CPAs stay up to speed. I'm very pleased to welcome today our special guest, Bob Bosshard, the Chair of the Audit and Assurance Standards Board. Bob is a strategic leader and director with expertise in audit, finance, capital markets, risk management, climate, and ESG reporting. Today, he joins us to help us understand the recent revisions to the going concern and fraud standards. Welcome, Bob.
Janet, on behalf of the team at the Auditing and Assurance Standards Board of Canada, thanks for this opportunity to get together and discuss with your members the two very important standards.
Great. So for the audience today, we're going to spend the first 30 minutes going through the changes to the standards and what they mean for all of you. Following that discussion, we'll spend 15 minutes answering your questions. So let me kick off things by first highlighting some of the key changes to the going concern and fraud standards. On going concern, materiality uncertainty is now clearly defined, a gap in the previous standard. Auditors must obtain audit evidence, not just rely on discussions when risk assessing going concern. Evaluation of management's assessment is required in all cases, not just when risks are flagged. The assessment period now extends 12 months from the approval date of the financial statements. We also now have a separate going concern paragraph in auditor's report, not required under the existing or old standard. On fraud, there's now a dedicated section outlining required procedures when fraud or suspected fraud is identified. A new stand-back requirement is introduced to pause and reassess audit approach before wrapping up. Auditors must now explicitly understand how fraud could occur, including risks like management override and external pressures, versus it was implied under the old standard. The standards warn against relying on past trust in management and those charged with governance. And fraud-related procedures must now be described in more detail in the auditor's report. And for listed entities, significant fraud matters could be flagged as key audit matters. So with that, let's start our chat, Bob. Why don't you walk us through why the changes were made and why now?
Janet, that's a very good question. And in the introduction, you meant the world is changing quickly. In the area of going concern and fraud, there's been concerns raised around the expectation gap. And as a result, this brought to light concerns around audit quality, public trust, and corporate transparency following a series of global corporate failures, for example, Carillion in the UK and maybe Silicon Valley Bank in the US. So what are the updates focusing on? They're clarifying what the responsibilities of the auditor are. Part of the expectation gap is public interest is not too clear, so the revisions clarified that. It increases the rigor of risk assessment, building on the principles of CAS 315, and then importantly improving the transparency in reporting and communication to explain what the auditor did. So both standards were aligned due to the recognition that fraud and financial stress are often interconnected and affected audit governance needs auditors to address them holistically.
Great, thanks, Bob. And those concerns continue in the current economic environment for sure. So let's dig a little bit deeper into the individual standards. Let's start with going concern.
Right.
How have the auditor's risk assessment responsibilities changed under the revised standard?
So under the new CAS 570, the auditor's risk assessment responsibilities for going concern are now more explicit and robust, and they're more aligned with CAS 315, which is the risk identification standard. Auditors are required to determine whether any events or conditions exist that may cast doubt on an entity's ability to continue as a going concern, and to obtain sufficient and appropriate audit evidence to support the determination. Previously, risk assessment primarily included inquiry and discussion as a basis for evaluating management's assessment, but not quite as robust as we'd expect. The standard clarifies events and conditions that should be identified on a gross basis. What does the standard mean by that is the going concern risk needs to be clearly identified and understood before considering management's actions to mitigate. That way it places the concern into a proper context.
Great. Okay, so clearly the shift really underscores the importance of early identification of risks. Okay, so let's talk about management bias. Imagine management says everything is fine, no going concern issues here. What does CAS 570 expect you to do in terms of analysis?
So I think the key point with the going concern assessment for practitioners to understand, it's management's assessment is the starting point for the auditor's going concern evaluation. The auditor then designs and performs audit procedures to evaluate management's assessment, and this includes evaluating significant judgments, and the management's assessment is then based on indicators of possible management bias. So what does that look like? Engage with management, reassess audit evidence to consider whether sufficient appropriate audit evidence has been obtained that support the methods, assumptions and data used by management to make its assessment. Then you revisit the risk assessment to see whether the auditor understands the circumstances, and then sit back and assess the impact on the auditor's conclusion whether the financial statements as a whole are free from material misstatement. And as part of the joint tagging with the fraud standards, then sit back and say, are there any fraud considerations that this assessment then identifies? So what is management bias in terms of a going concern assessment? Management may ignore current market data. They may be more inclined to develop internally developed data, which is more favorable than you'd expect. They may change their methods, change their assumptions from prior periods, perhaps without a valid reason. And when we're dealing with owner-managers, is understanding the influence that the owner-manager may have on the process to put their views forward in completing that assessment.
Great. Yeah, those are great examples and should really help the audience. So how is the auditor's report evolving under the new standard, and what should stakeholders be noticing that wasn't as clear before?
Right, I think one of the key objectives in addressing the public interest on the going concern revisions was increasing transparency and providing clarity about what the auditor actually did. So what can we expect to see? The audit report will now include an assessment about whether management's use of the going concern assessment was appropriate, or is there a material uncertainty that exists. So depending upon the engagement circumstances, you're either going to see a new section under the heading Going Concern, No Material Uncertainty Exists, or a section with a heading Material Uncertainty Related to Going Concern, where there is a material uncertainty that exists. So whether or not there's an uncertainty, the auditor will disclose in the report their findings and their assessment.
Great. Okay, so we've covered going concern. So let's turn our attention to the amended fraud standards and talk about professional skepticism, one of the core qualities of a CPA. How does the updated standard help strengthen the mindset and behavior?
Professional skepticism underlines the work of a practitioner in the execution of an audit engagement. The fraud standard reinforces the importance of exercising professional skepticism throughout the audit. So beginning at the beginning, the standard removes language about past honesty and integrity of management and those charged with governance that could potentially undermine the exercise of professional skepticism because it creates a bias going in. The new standard wants the practitioner to approach each audit with a fresh pair of eyes. Throughout, there are new requirements to reinforce professional skepticism, including remaining alert for previously unidentified fraud risk factors and indications of fraud or suspected fraud, and designing and performing procedures that aren't biased towards obtaining audit evidence that either corroborates or contradicts management's expectations. So it's a more balanced view, a more skeptical view on the circumstances. Then at the end of the audit, professional skepticism is demonstrated by using new stand-back requirements, building off the work of CAS 330, which is the risk response standard. Is gathering the evidence, standing back, and assess whether or not there's a risk of material misstatement due to fraud. The thing that the standard introduces is a bit of a duality. So the auditor is engaged to complete an audit of the financial statements. At the same time, there's an expectation that they're aware and keep a lookout for fraud indicators as part of the process, which is a little expanded from the previous standards.
Okay, great. So if an auditor spots signs of fraud, what's changed in how they're expected to respond under the revised standards?
So I think in looking at fraud, we need to look at fraud from two perspectives. One is that the auditor has identified a risk of fraud, and secondly, the auditor suspects fraud or finds an actual fraud. So from a risk of fraud, the assessment is pretty well unchanged from the prior standard. If there's a risk of material misstatement due to fraud, and it's a significant risk, then the auditor would design and perform audit procedures accordingly just to address that fraud factor. I think it's important to recognize that while fraud risk factors may not necessarily indicate the existence of fraud, they have often been present in circumstances where frauds have occurred, and therefore may indicate risks of material misstatement due to fraud, and auditors then can focus their efforts on these areas. Now it gets a little more interesting when we talk about suspected or actual fraud. So for the purposes of an auditor is concerned with material misstatement of the financial statements due to fraud. So what the auditor may do is identify or suspect of an occurrence of fraud, but the auditor does not make a legal determination about whether the fraud has actually occurred. This remains unchanged from the existing standard. But the standard then clarifies what the auditor does in those instances where they may suspect fraud, including allegations of fraud, which then now become within the statement. So for example, if the auditor identifies a tip that's come through a whistleblower hotline, the auditor then has to consider the suspected fraud and then making determinations whether a fraud has occurred or not. And there's a new section in the standard to be performed when fraud or suspected fraud is identified. So the standard now requires the auditor to obtain an understanding of all instances of fraud or suspected fraud in order to determine the effect on the financial statements. The standard introduces a bit of a threshold, which then allows the auditor to exclude from further consideration those items that are clearly inconsequential. But the standard specifies that the evaluation of the impact on the audit approach is the responsibility of the engagement partner with input from the engagement team.
Okay, great. So when it comes to the auditor's role, what are the key things that CPAs need to communicate to those charged with governance, and why does that communication matter?
I think what's important when we talk about fraud, and it comes out on the work done on the auditor expectation gap, is that the primary responsibility for the prevention and detection of fraud rests with management and those charged with governance. It's important that management and those charged with governance have a thorough understanding of fraud risks at the entity or any identified or suspected fraud. So what the standard does is clarifies the auditor's responsibilities that helps address this expectation gap.
Right. Those are great points, Bob. Obviously, we all know CPAs play critical roles, and they wear many, many hats, like on boards, audit committees, those charged with governance, in management, in preparers, as well as in their role as auditors. So important that CPAs understand the changes and how it impacts their own roles. There's a bit of something for everyone here. So great. Okay, so I'm going to ask the popular question. We get it a lot, which applies to both the standards, both going concern and fraud, are the revised standards scalable for audits of less complex entities?
Yeah, that, as you say, Janet, that's a really topical question and an area that the board is working on all standards, not only the two in question, going concern and fraud. And the answer is that in the preparation of standards, now scalability and proportionality are top of mind and key principles. So the short answer is yes, they're scalable. And the revised standard includes application material and examples that discuss the proportionate application to smaller and less complex entities. So for example, when planning and performing engagements for less complex entities, keep in mind that additional application material and examples are not meant to be a checklist, but just to help the practitioner design the audit process and gathering audit evidence. And then the key, regardless of the size of the entity, is ensuring that the practitioner completes a robust risk assessment. Auditors then can focus on the fraud risk factors that are relevant to the entity of different sizes and complexities. But I think what's important, scalability is achieved by adjusting procedures rather than omitting them. So for example, if the entity is small and sells only a few products and services, the auditor could perform targeted analytical procedures, comparing monthly sales to prior periods, investigate unusual spikes, and corroborate management's explanations with customer invoices or shipping documents. If the entity uses a manual record system, they can review duplicate sales near a period end or cash receipts that don't match with the physical delivery dates, and just interviewing staff interviewing staff to ensure there aren't any pressures to meet sales targets or inconsistent documentation.
Okay, great. We often hear from our small and mid-sized practitioners that scalability is important for the markets that they serve. So let's jump into questions that we received from our audience. We've received many great questions from our viewers. We may not be able to get through them all, but we'll group them under common themes and hope to get through as many as we can. So let's get to the first question. Maybe the most important question. Bob, you have some fans out there. The viewer asks, which Premier League team do you support?
It's a nice transition from the theoretical into some questions. I'm reminded a bit of the Blue Jays with the World Series events. Outstanding performance. I think we all hope for a better conclusion. When I was growing up as a kid, England was hosting the World Cup, and in preparation for that, there are a lot of exhibition games, friendly internationals in preparation for the World Cup. There were three players that stood out in my mind at the time. Bobby Moore, who was the captain of England, Jeff Hurst, who scored the winning goal, and Martin Stiles. All three of them played for the same team, and that was West Ham. And since then, I've been a strong supporter of West Ham, and get to see them whenever I can. So that's a bit of a respite in terms of the technical questions.
Great. Okay. So in all seriousness, let's get to some questions. We have a timely question from our audience. How should auditors incorporate external economic factors like tariffs into their going concern and fraud risk assessment under the revised standards?
Yeah, that's a good question in today's terms. I think In completing an assessment, whether it's going concern or fraud, economic factors are considered as part of the risk assessment process. So under both 570 and 240, risk identification and assessment has been closely structured to align with CAS 315, the risk identification standard, and it demonstrates the interrelationship of some of the standards that a practitioner works with. In my mind, when we deal with economic factors, it builds upon the practitioner's understanding of the entity. It's a bit like know your client, what environment do they work in, what's the applicable reporting framework. So for going concern, economic factors are considered when the auditor determines whether there are any events or conditions that may cast doubt on a going concern, whether those have been identified. In fraud, the economic factors increase the susceptibility to misstatement due to management bias or risk factors. So economic factors also come into play when we look at the fraud triangle: pressures, incentives, opportunity, attitude, and rationalization, to identify if there's a fraud risk factor present. So for example, pressure. Tariffs can increase financial pressure on companies by raising the cost of imported goods. Opportunity under a tariff situation may introduce complexity into supply chains and processes, and any gaps in oversight could create opportunities for fraud. Rationalization. A manager could rationalize it by misclassifying goods to avoid tariffs by believing it's necessary to keep the business afloat or protect employees. I've got some interesting examples in today's environment.
Yeah, really interesting. Another question we received, what questions should those charged with governance be asking to auditors with respect to changes to the fraud standards?
Yeah, and that's another very important question, certainly as we get into the planning for audits after December 15th, 2026, when the new standard comes into being. So the first question is, how have the auditors, practitioners responded to the standard? How have they changed the audit approach so they can prepare scheduling communications, preparing risk assessment inquiries? For listed entities, it's important to start discussions around key audit matters related to fraud, because that, for listed entities, is a new requirement, as you mentioned in your introduction. And if we can consider them early, it then provides an opportunity of socializing what those communications will look like in the audit report.
Okay, great. Another question, where does Bob see the greatest areas for improvement for an auditor's approach to assessing the potential of fraud in an audit engagement?
Again, the genesis behind the changes to the fraud and the going concern is focused around the practitioner performing robust risk assessments, understand the risks of material misstatement, and then design an appropriate audit response. So with CAS 240, it builds on the fraud perspective in the CAS 315 requirements, identifying fraud risk factors. It's a bit of this parallel audit between the financial statement audit and then being sensitive to fraud factors. So fraud risk factors don't always indicate fraud, but commonly occur when fraud is present, which is an interesting statement, and they also become key warning signs to the practitioner. So by focusing attention on fraud risk factors, auditors then can focus their attention on areas of greater concern of material misstatement due to fraud. So applying it to the less complex entity, by understanding the risk, one is then able to design a very specific, tailored approach to address those risks.
Okay, great. Can you give us some examples on how to initiate discussions around going concern with executives and management level? What's the starting point to ground sometimes very difficult conversations?
It is.
Yeah.
I think I'm reminded of the commander of Apollo 13 as he heads to the moon, and there's a bit of an instant he turns around and says, "Houston, I think we've got a problem." I think in the practitioner space, this is probably as close as you get to the "Houston, I have a problem" problem scenario. I think what's important in the discussion is that management is responsible for putting the going concern assessment together, and then the auditor then evaluates the assessment accordingly. So starting off with that conversation is not one of the easiest ones. It's a highly judgmental area. So I think the auditor then needs to ensure that the management is aware of the process. The fact you mentioned in the introduction is that the assessment now covers a 12-month period from the approval of the financial statements. The auditor's conclusions are included in the audit report. And then the challenge is when the auditor identifies a different view on management's conclusion. And that's where you need to have a frank discussion with management to understand what is causing the difference. Why would an auditor interpret an assumption or a series of facts slightly different from management? And then based upon those discussions, perhaps the auditor has got additional insights, or the auditor may then have to gather more evidence to validate management's new assertion in preparing that information. And then because of the difference, the auditor may then have to carry out additional audit procedures, and in the end, the auditor would then need to reach a conclusion around the going concern assessment to put their conclusion in the report, whether or not there is a material uncertainty.
Okay, so we've been focusing on the auditor's responsibilities. There's obviously, as you said, some knowledge on behalf of what management needs to do, those charged with governance. So important that we get, we get that knowledge out to that base as well.
Yeah.
As I said, CPAs wear many hats, and hopefully we've got folks in the audience that are wearing the various hats, understand what their obligations are under the standard. Maybe we need to get in front of boards, board of directors, educate them on, some of the changes here, what the expectation will be of them, as well as management. So it's a really good call out.
Mm-hmm. Absolutely.
Okay. So how does the AASB envision the rebalancing of the responsibilities of the auditor with management and those charged with governance? We've touched a little bit on that, but
yeah, I think the auditor expectation gap in this particular area is from a public interest perspective, understanding whose responsibility is it. What the fraud standard does, it talks about auditors' responsibility in the revised statement hasn't necessarily changed from the existing standard. They still must remain to plan and perform an audit to obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement due to fraud. And the standard then continues to highlight the primary responsibility for the prevention and detection of fraud remains with management and those charged with governance. So there's a clarity around responsibility for the initial evaluation. So what does the standard actually say in terms of revision? It describes the auditor's responsibility, and that has been moved to be more prominently disclosed within the standard. So it's a lot clearer to the practitioner what it is that they're responsible for. And it also describes auditors' responsibilities as being separated between sort of inherent limitations because of the audit process itself, and ensuring that the concepts are communicated as part of the discussions with those charged with management. And then the aspects around clearly articulating what those responsibilities are. The idea is it then becomes clear in the public interest what the auditor is responsible for, then addressing concerns raised in the expectation gap studies that have been carried out.
okay. Do we anticipate seeing an increase in fraud-related CAMs for listed entities in Canada because of the revised standard?
Yeah, one of the key key changes in the fraud standard is increased transparency within the audit report. So I think the answer to the question is yes. I think we'll see that there will be more explicit CAMs related to fraud in the audit report. In many cases, CAMs related to fraud will be disclosure of fraud risks and not necessarily actual fraud. Many of these risks are consistent year over year, such as the risk of management override of controls and presumed risks of material misstatement due to fraud in revenue. But you may also see existing CAMs that have been expanded to include a fraud lens. So, for example, there may be an existing CAM that deals with impairment. And so that may then be further expanded to consider the fraud risk factors when discussing perhaps management bias in making judgments about future events and conditions.
Okay, great. So a lot more disclosures, transparency. Any risks from investors reading it, from stakeholders, confusion in the a lot of additional disclosures?
There's a risk when one gets into key audit matters disclosures in the audit report. They tend to be boilerplate. The idea behind the expanded transparency is to provide additional information to the users of the financial statements about risks that are embodied within the financials and how the practitioner responded to those. So the idea is to provide useful information. The marketplace will determine whether it is useful. Experience through the key audit matter research has been undertaken is that it is useful information, and I think that will continue both in the areas of going concern and fraud. And the idea behind the way that the standards have been revised is to provide clarity in the marketplace around whose responsibility it is for certain aspects of key judgment areas in the financials, where what the auditor responsibility is, and more importantly, what is management's responsibility in those charged with governance. So that's all brought together with the disclosure in the audit report of fraud or going concern.
Mm-hmm. And should we be thinking about educating stakeholders? When they see a report get larger and longer, their inclination may be to worry, but educating them on the updated standards requirements. Hadn't sort of thought through that pocket of stakeholders.
Once upon a time, the audit report was relatively brief, a couple of paragraphs, and that was it. Over time, using the transparency lens and a demand to have more fulsome disclosure has led to the audit report becoming a little longer, and in particular for listed entities with the introduction of CAMs in particular. So the view would be, is longer necessarily a bad thing? There may be those out there that would suggest perhaps it is, because it may cover issues, but by having all these additional paragraphs. But the objective is to be more transparent and provide more meaningful information to the marketplace to help readers understand the financial statements.
Okay, so we've covered a fair bit. When we think about each of the stakeholders that are impacted by the standards, any key messages for each of the stakeholder groups? I know we've talked a lot about it, but just to really hone in for our audience.
Each of the interested and affected parties has a particular interest. I think from a preparer's perspective, the standards provide clarity around expectation, in particular by moving the going concern assessment to 12 months from the date of approval. That's different. It's not necessarily unique in the Canadian perspective. In a global perspective, other jurisdictions have already done that. From a user's perspective, they're going to receive more information about the risks embodied in a set of financial statements. What is the risk? How did the auditor respond? What was the conclusion of that assessment? And they're dealing with highly judgmental areas. Going concern and fraud are probably some of the highest ranked judgmental areas in the audit process. So the idea through the standards is to clarify for the auditor what's expected of them, clarify for management and those charged with governance what's expected for them. So when the statements are in the marketplace, the reader of those statements understands the risks embodied in the financials, risks embodied in the business.
Okay. We received a few more questions. Can you clarify the statement that a key change is a requirement to evaluate management's assessment in all cases? In the previous standard, CAS 570.12 also states the auditor shall evaluate management's assessment.
So, sorry, just the first part of it.
Can you clarify the statement that a key change is a requirement to evaluate management's assessment in all cases? In the previous standard, CAS 570 also states the auditor shall evaluate management's assessment.
I think the clarification in the 570 standard is suggesting that from an audit perspective, the evaluation of fraud is required in all cases. I think under the previous standard, there was a sense that if the auditor didn't believe that there was a fraud risk, that perhaps they then could then move on to the next point. I think what the clarification around auditor responsibility is doing is for each engagement, the auditor applies a fresh lens, because the other part of the standard, I think we'll probably go on to say that you assume the management's acting in good faith and using that prior knowledge to influence the judgments of the current audit. So what that sentence says is, regardless of what may have happened in the past, you're required to do an evaluation of all, in all cases, and the degree of documentation to support that would be then contingent upon the auditor's assessment of fraud risk in that particular engagement.
Okay. The next question from the audience: what is the expectation under revised CAS 240 in terms of involving forensic specialists? It's an interesting question.
It is an interesting question. If you, based upon feedback from the regulators, they would suggest that in certain circumstances, a fraud specialist would be a required component of the engagement team. What's important from the practitioners and the engagement team to consider is if their risk assessment identifies a potential risk area, I think one of the options available to them would be to engage with a fraud risk forensic specialist. It may be because the risk identified is a little unusual. It may be the business in which the client operates is a little unusual. There may be certain geographies that the client operates in that have got certain risk exposures, and the forensic specialist will be able to help the team understand the risk, discuss with management what they're seeing, and help the team devise appropriate audit procedures. So the use of a specialist is always an integral part of an audit team. I think the teams would be selective depending upon the fact and circumstances. So we would expect to see forensic specialists used in certain cases.
Okay. Well, I think you've addressed the follow-on question that the audience member had. How do we know when we need to and when we don't need to involve them? I think your examples there, excellent. So another question, under the new going concern standard, is management required to make a going concern assessment no matter whether there are events that could cause going concern problems? There are events that could cause going concern problems that are identified by the auditor?
Yeah, it's in the going concern assessment process, quite clearly the practitioner is going to be faced with a range of client circumstances. There are going to be those clients where going concern is not an issue. There are going to be those clients where it might be an issue. So what the going concern standard says is, let the auditor complete their risk assessment, understand the client, understand how the cash flows are to determine the extent of work that's performed. The expectation under accounting frameworks is that a going concern assessment is made. The periods are a little different, but nonetheless there's an expectation. What will be different also is the degree of detail that management puts into the analysis. Because if it's clear that there aren't any pressures, the analysis would be a relatively high level. And the auditor, based on their knowledge of the business, would then determine whether those assumptions are right. Where the focus is usually on those borderline cases, where there is a concern around liquidity and cash flow, where the degree of analysis becomes a little more detailed. And the other part of that question is quite interesting if you look at it from a less complex entity. Because in a less complex entity, the resources to prepare a detailed cash flow analysis may be relatively limited. So the nature of the review may be based upon discussion, inquiry with management, looking at particular supporting evidence behind management's assertions to form a conclusion around going concerns. I think there are two extremes, depending upon whether it's no issue versus a smaller entity where the expertise is relatively limited, so the level of detail will also be relatively limited as well.
Okay. Another question, can you elaborate on any limitations on the rebuttal of presumed risk of fraud in revenue recognition under the new fraud standards?
Mm-hmm. That's a great question, and I recall discussions at a board meeting around rebutting risk. Depending upon who you would speak to, if it's a relatively straightforward revenue stream versus a more complicated revenue stream, it would determine the extent of work performed. In terms of rebutting the risk, rebutting the fraud risk of revenue, it's based upon the auditor's assessment of the risk of a particular revenue stream, and that then would determine the extent of work performed. The rebuttal remains, and one just tailors it accordingly.
Okay, great. Well, we are running up to our time. Thank you so much, Bob, for your insights and taking the time to be with us today. Our members need to understand the impact of these revised standards. Thank you also to everyone who joined us today. Watch your inbox for a link to today's on-demand version of the event. And of course, be sure to check out CPA Ontario's Guidance on Compliance Hub for more information on changing standards, the impact of disruptive technologies like AI, and everything CPAs need to know to stay current and compliant. So have a great afternoon, everyone, and thank you. Bye-bye.